Hi, good morning.
Hi, good morning.
How are you doing
How are
today?
you
Merry
doing
Christmas
today? Merry
and
Christmas
a
and
prosperous New
Happy
Year,
First New Year,
everyone.
everyone.
So today
So
we'll be
today
talking
we'll be
about
talking about UAE
corporate tax
Corporate Tax
implementation.
Implementation.
But before we
But
begin, let
before
me
we
take a
begin,
moment
let me
to
take a moment
introduce Dicalo
Dicalo
Consulting Group.
Consulting Group.
Dicalo Consulting
Dicalo
Group is a
Consulting
leading
Group is a leading
firm that provides
that
that
provides
provides
that provides
expert advice
expert
and guidance
advice and
on tax,
guidance on tax,
accounting, and
accounting,
business
and
setup.
business setup.
And we also a
And we also a
human resources firm. You
firm.
can actually
You can
outsource
actually
your
outsource your
management work.
management
We
work.
help you to
We
recruit
help you to
talent,
recruit talent,
and we can also
and we
help
can
to set
also
up a
help
business
to set up a business
in any part of the
in any part
country.
of the
We
country.
have
We have
operations in
operations in
Nigeria. We
Nigeria.
have operations
We have
in Ghana.
operations in Ghana.
We have operation
We
in
have
the
operations
UAE.
in UAE.
We have
We have
operations
operations in the
In the Middle East and
Middle East and
Central Africa.
Central.
The Dicalo Consulting Group helps business to navigate the complexities of tax, recruitment, tax laws, regulation, and many other business issues, ensuring compliance and optimizing tax efficiency. Now it's my pleasure to introduce our speaker for today's event, Mr. Ndedi Betrand. He's a seasoned tax specialist with an extensive expertise in tax, especially UAE tax. So today, Mr. Ndedi will be sharing valuable insights on the implementation of the UAE corporate tax, providing you with practical guidance on how to prepare your company and comply to the tax regulations. So without further ado, please join me in welcoming Mr. Ndedi Betrand. Mr. Ndedi Betrand, are you on? Welcome.
Yes, perfectly
Thank you
well,
for
thank
joining
you.
our live. Yes, thank you for joining us today. We really appreciate. So the floor is open. The floor is open for you. Please,
Thank you very
you can take
much,
us through
Madam
that.
Favor. Thank you very much, Madam Favor, for this privilege to have this done
Thank you,
in
Betrand.
Dicalo Consulting. And it's a great pleasure. And I guess I'm very, very audible
Yes.
and I'm free to speak. The audience, it's been a privilege, of course. It's no news. The UAE corporate tax is going to a year, and we are almost completing the famous period, of course, of the January to December calendar, which is very, very important that companies should be adjusting themselves in order for them to be ready to file, most of the company to file their very first corporate tax return. So it's of course no news that the implementation of corporate tax started a long back, that is June 2023, which of course many other companies had submitted their first return, especially companies with period starting from June, of course. This, of course, has kept a lot of companies with different ideology, different mindset about the corporate tax, which, of course, they are still trying to adjust to the new tax laws. And in this session, of course, you are free to ask questions relating to your doubt, which, of course, we are readily available to answer. And we're just going to give some intro and also, of course, talk about the recently introduced the global minimum tax of 15% and why it's done, and some of the principles, of course, of they talked about UA corporate tax. And going forward, like I said, it's no news. Tax is a direct tax, which of course it requires companies to submit registration. And I guess many companies, right up to now, they have already registered, especially companies which they had been existing before now. It's compulsory when it comes to registration, but till yet, when it comes to sole proprietorship, it requires them to reach a particular level of turnover of 1 million because they are deemed considered like a natural person operating in the form. of a business. But when it comes to corporations, all companies which requires or which work under this jurisdiction of UAE, which is the source, which is the state, is required to obtain a license, which of course requires them to must register for corporate tax. And now corporate tax is still fresh, though it's gone more than a year. It doesn't require any level of turnover, as people may say, income of companies. Direct simply means, like I said, it affects income of companies. It's not similar to VAT because VAT is totally indirect. Companies are just intermediaries. So going further, we understand that it's almost a year for the famous first period of most companies of January to December, which means at this stage, companies should be ready to file their corporate tax return. And the question is, what should companies with a period from January to December, because there are different periods. Your period of return is determined based on your memorandum of association, or you follow the Gregorian calendar or any other date or period, sorry, as may be authorized by the Federal Tax Authority, which is the sole governmental enterprise, which is handling the implementation and the guidance, compliance of companies in this state. So, like I mentioned before, it is of great importance for companies to understand that, especially that the fact that they are going towards the end of their first quarter, what they have to do for them to remain compliant and make sure that they meet up with the tax regulation. The famous first period, January to December, is coming to an end. And what can companies do? What should companies do to meet up with? The very first thing, companies have to properly adopt their IFRS, in particular IFRS 15, when it comes to revenue recognition. Why? Because the UAE Corporate Tax Law stipulates that the only accounting standards to be used is IFRS. IFRS for small business and IFRS itself for large corporations, which means companies that were using other standards, they have to switch, okay, particularly. Secondly, companies have to check properly and recalculate their deductible expenses, because there are certain expenditures which are not deductible, which we are going to be outlining subsequently, and there are some which are not deductible at 100%. So it is, of course, very essential for companies to take note of this kind of expenditures, as it will help them reduce their tax burden, because taking into consideration all your expenditures that are to be deducted helps you reduce your tax burden and is part of what? Your tax planning. It is very essential for companies to understand that tax planning, of course, starts with you understanding what is required of you. And tax planning is all about a long-term process. It's a continuous process. It's not just a year start process. It's a practice that has to continue throughout your fiscal year. So understanding the expenditures that are to be deducted and deducted properly, those that are to be deducted to a certain limit, gives you an ample chance for you to take over your liability and see how you can take the advantage to reduce it. Also, taking note of what disallowed financial cost is very, very important, particularly interest, which of course deductibility is not 100%. And this particular interest is interest on loans, interest on financial related transactions. Also, taking note of what? Any transactions relating to what? Related parties. Related parties here simply means entities that are related in one way or the other. For example, a person can own 5 different companies. All of them, they are located in UAE. These companies are not registered as a tax group, but to an extent, they are related. So transactions between these companies are very, very important to be identified and treated at arm's length, making sure that it meets what the required standard as stipulated by the law. These are certain areas where the auditors will be actually focused on. They will be pinpointing all these areas to make sure that what companies meet up with the required laws, because it's like an eye opener. So UAE tax is very simplified and not complicated as compared to other tax in different countries. And like I said, the year is approaching. This is, of course, not new. That's why we're going to focus on that are more recent, and also things that are more relevant at this point in time. Going further, the recent law, of course, of the global minimum taxation, which I am very particular to talk about, is very essential, especially when it comes to multinational organization. Though it's still to be fully effective in UAE, but it's very important that companies that operate in different jurisdiction here, different countries, they have to take, because it seems like such companies or such establishments, they carry out a lot of activities which makes them to reduce their tax burden in one way or the other. And that is why the Pillar 2 of the global minimum taxation is coming into play, in order for companies to pay the required tax irrespective of where they are located. Irrespective of where they are located. As of now, over 100 countries have enacted these laws, and UAE is also one of them, which makes it a little bit complex for companies that they operate in different countries. So, knowing fully well that UAE corporate tax is at 9%, the global minimum tax is at 15%. Now, this is the minimum tax companies that operate in different or multi-jurisdiction they're expected to pay, irrespective of their location, because intercompany transactions are always internal and is seen to be beneficial, or company to use it for their purpose to reduce their tax liability in areas where the tax rate or the tax policies are not favorable to areas where the tax policies are much more favorable, in order for them to gain an extra edge on their profit, thereby shifting the profit to areas where the tax policies are favorable and they have what low tax rate or low tax rate. So mostly companies that are located at the level of the free zone, they will be more affected by these, because they are mostly multinationals, those that are always at the end nearer to the world market. I'm talking about the free zone. It is very essential for us to understand that corporate tax regime is also applicable on all the free zones. But more emphasis is laid on the fact that free zones are special when it comes to corporate tax, in the sense that some free zones companies are considered to be what qualified free zones, others not qualified. Which means that for a company to be qualified free zone person, the company is not liable to the standard rated 9% corporate tax regime. That is to say that the company must have met certain conditions to warrant them to enjoy this qualified status. What are those conditions? The very first condition, the company should be able to maintain adequate substance in the free zone. Adequate substance here, we simply talk about they should be able to have a presence in the free zone. The required human capital in the free zone, the required fixed asset located at the free zone. This is because many companies can obtain license in the free zone from the free zone, but don't operate from the free zone. They can operate elsewhere, but their license is from the free zone. So for a company to enjoy a qualified status, the very first condition, they must have sufficient substance in the free zone. Secondly, the company must be able to subject its records to annual audit, meaning the financial statements of the company must be audited annually. Also, the company must have not opted out of the qualified status. For example, there can be companies in the free zone that may want to be subjected to the standard rated system. So for a company to enjoy or continuously enjoy being a qualified company in the free zone, a company must have not opted the standard rated of 9%. But if so, the company will have to maintain the status of not being qualified for up to 4 consecutive fiscal years. So, because being qualified simply means you enjoy the status of what? 0% corporate tax rate. Also, the company should be able to adhere to the transfer pricing regulation. The company should be able to adhere to the transfer pricing regulation. The transfer pricing, of course, which has to do with pricing between related parties for control and uncontrolled transactions and connected persons, which has to do with you determining the pricing for transactions between parties, between companies that are related to your company in one way or the other. So much so that such pricing for the transactions, irrespective of whether it is services, should meet arm's length. The company must show proof of its transactions meeting the arm's length. Also, adhere to the minimus requirement. The minimus requirement, which states that the company should not have revenue, which is not qualified revenue, up to 5 million or 5% of the total revenue. Now, companies that are called qualified, that have gone through all these conditions, of course, which the condition is continuous, because at any given point in time, one of these conditions are not met, the company ceases to become a qualified establishment or qualified free zone person. So, at all and every given time, the company must adhere to the conditions for it to keep on enjoying the qualified status. Like I mentioned before, some companies in the free zone may not want to be qualified company. This is because there are certain other advantages which are not enjoyed by qualified free zone person, but they are enjoyed by the standard rated companies, such as the small business relief, which is a relief which allows company with turnover less than 3 million to keep on enjoying what? 0% up to 31st of December 2026. So there can be companies in the free zone that may want to opt out from being what? A qualified person, just to enjoy such qualities. Now, irrespective of the location, the same tax return will be filed. irrespective of the location. And the tax return of corporate tax is so simplified in such a way that it just needs you to put in your calculations done properly, prepare your financial statements very well, because your profit and loss, your balance sheet will be required when submitting your return. So companies, of course, that have never been keeping record, this is the time that you have to understand that for you to submit your return, you have to prepare your financial records properly, because it will be required third at the third table for you to include when submitting your return. Now, it is compulsory in the sense that it doesn't take into consideration your scale of operation, whether you're operating at a very low scale or high scale. All the requirements must be met. So much so that the basis through which you determine your taxable income, which is the income after you must have done your adjustments of your accounting profit, can be shown. And your accounting profit is determined from, of course, your profit and loss statement or your comprehensive income statement. Now, the net income from your comprehensive income statement is the basis through which you start your computation of what? Your taxable income determination, where adjustments have to be made on the accounting income. And what are those kind of adjustments? For example, we talked about some deductible expenditures and non-deductible expenditures. And some of these non-deductible expenditures are such as what? Fines that you get as a result of what? Tax, or imposed to you by the law. You have non-deductible VAT. All illicit payments, such as bribes, they are not deductible. Donations made to unqualified public benefit organizations, that is, charitable organizations that are not recognized by the law, they are not deductible. Entertainment expenditures, which can be deducted up to 50%, because, of course, the law understands that many businesses, they carry out activities which promote their business through having maybe dinners with stakeholders such as suppliers, customers, shareholders, to negotiate business related operations. So that is why, in order for companies not to abuse and try to use the entertainment, it has a deduction up to 50%. Outside that, so much so that when calculating your comprehensive income statement, probably you must have deducted 100% of the entertainment expenditures. At the level of your adjustment, you have to reinstate back 50%, or you reinstate all and you deduct 50% only. Financial costs such as interest on loans are deducted up to 30%. This is so much so that companies that operate on debt capital, of course, financial related interest are expenses. Companies that operate on debt capital will have what? High interest expenses. And for the government, regulate such operations so that companies can be able to operate more on equity capital than for them to get more debt to finance their businesses. Regulation on the interest up to 30% rule was placed, which means when determining your net income, you must have subtracted everything, but you have to readjust it back, and only 30% can be deducted. The computation of corporate tax is very easy, especially when you have the right knowledge, the right hands to assist you in. Now, going back to the free zones, because when it comes to the mainland, much focus is not determined because it's just straightforward. It's just straightforward. But when it comes to the free zone, a lot of conditions, a lot of principles comes into play. But one thing we should understand here is when it comes to the mainland, audit is not compulsory to submit your corporate tax return. Carrying out an audit is not compulsory. But when you are working on a complex organizational structure, which large scale is required for you to audit your financial statement. Now, like I mentioned before about qualified free zone person, and I have mentioned quietly the conditions to be qualified free zone person. It is worth pointing that for you to be a qualified free zone person means you must be carrying out qualified activities and you must enjoy qualified revenue. Qualified activities here are those activities which you carry out which are not within or which are not outside your scope of operations. For example, when if a free zone company purchased or sells some item to a mainland company, the revenue generated from a mainland person is not qualified. And now, such revenue is not a qualified revenue. That is why you see many companies that have mainland presence and that carry out interborder transactions, they have what? Free zone presence. Because insofar as the beneficiary of the revenue is with the free zone, it can hamper its smooth existence to enjoy what? Qualified status. Being a qualified free zone person allows you to enjoy 0% corporate tax regime in the UAE. And knowing fully well that it can be somehow advantageous to enjoy 0%, companies will not want to allow themselves to go out of the law for them to be disqualified from enjoying this 0% corporate tax regime in the UAE. So by so doing, meeting all the required conditions is very essential. And like I pointed before, by any point in time, one of the conditions are not met. Let's say, for example, you have been operating throughout the year, and November you fail to meet one of the conditions in which you just had December to complete your financial or your fiscal year, if by November you fail to meet one of the conditions, you lose being a qualified person. Excuse me, you lose being a qualified person throughout the year. That is from January itself. From January itself. And that is why knowing the criteria is very important. Staying in line with the law is very important. Making sure the regulations are fully implemented is very important. Making sure your financial records are properly kept and within arm's length. That is, making sure that your transfer pricing documentation, your master file, your local file, and your country by country reporting is very important. And meeting any of the five methods of the transfer pricing. Making sure your audited records are very available is very important. As of now, there are still no strict policy to determine which audit firm has to audit financial records. But all approved audit firms can audit the financial record acceptable by the law. And this is very, very important, as it is one of what the many other criteria which is used to determine being a qualified person. Yes, I have some noise. Okay. When it comes to the free zone again, transactions between unrelated party, between natural person, between companies located in the mainland have to be strictly be regulated, as most of the transactions between the free zone person and a natural person and the revenue generated from such transactions are not qualified. So it is advisable for companies to have strategic consultants to guide them on what it takes for them to maintain their status as being qualified free zone person. Now, having said all this, it is worth noting that this is the period where companies should be thinking of closing their year, should be thinking of the liability they have to pay under corporate tax. Now, focusing on the calculation again, it's worth noting that for companies that are under the standard rated, any taxable income that is below 375,000 dirhams, that is approximately $100,000, it is totally classified under the 0% regime. It is classified under the 0% regime. But any taxable income excess of 375,000, the 9% has to be applicable. Now, this is the law. And companies under the standard rated regime also have the small business relief also. Now, the question is, what if a company has below 3 million, which falls under the small business relief, and they have a taxable income above 375,000? What will happen? The small business relief takes over because the revenue is below 3 million. The revenue is below 3 million. Now, when we say revenue, we say the total sales within the fiscal year is below 3 million, which means having below 3 million, irrespective of if your taxable income is above 375,000, you will still be classified under the 0%. But it is worth noting that qualified free zone person with non-qualifying revenue don't go under this rule of below 375,000, 0%. No, they don't go under this rule. So, keeping the required records, all your source documents, your bank related statements, your calculations, all these documents have to be kept properly for up to 7 years. This is the time frame where you have to keep your documents that are related to the corporate tax. Up to 7 years means this is 2024. 7 years from 2024 inclusive, you have to make sure that your documents are in line, because at any point in time, the FTA, the Federal Tax Authority, have the sole responsibility to request for an audit or for your documents to be audited. And the audit can take place either at their premises or in your premises. It is at their sole discretion to determine the place of the audit. And it is worth noting that companies always have to take note of the deadlines, which is 9 months. For example, companies that falls between January to December period, they have to submit their returns and pay their tax liability on or before ending of September. On or before ending of September 2025. This is the time frame which companies are expected to must have calculated, submit their corporate tax returns as required by the law. But let's take note that all companies submitting return as expected, their financial statements have to be prepared. It's very important. And this is one thing that many companies undermine. This is one thing that many companies undermine, keeping financial records. But now, keeping financial records is not only for tax purpose, but it helps a company as a company, because it helps to monitor the performance of the company. And not keeping financial record makes a company not to evaluate its activity and not to determine their profitability, not to know where they are going to and where they are standing. And one thing I would like to point out here is that many companies with micro operation, have to be very careful, especially those whose owners are directors or managers of the company. They have to be very careful, especially when giving themselves salaries. This is because salaries of the managers or directors are not determined by the position or by the personality. That is to say, you will not say because this person that is the manager is the owner of the company, the person has to take 800,000 dirhams a month. But the salaries determination have to follow arm's length, which means similar position in similar industry in the market. What are they offering? The salary has to be the same. Or if somebody else was to take that position, would that same salary apply to that person? This is what we mean by arm's length. So arm's length is not only applicable to two companies related, but it's also applicable to people, connected persons, people that or stakeholders that are linked to the company in one way or the other. In as much as many people think that payroll can be used to inflate the expenses of the company, but care should be noted, especially that is why you see the wage protecting system is being used as well to pass salaries, which of course act like proof of payment to employees to guarantee them receiving the set salary. And of course, the pay slips are there. But I'm not saying that there are not other ways which legally tax liability can be reduced. Like I said before, taking advantage of the expenses, taking advantage of all the related business relief, taking advantage of bad debts adjustment by the law, as per the case of VAT. All these are very important. All these are very important when noting. So, in case there is or anything within the corporate tax that is not well understood, because there is no ignorance in front of the law, you have to meet your consultant to assist you with. You have to meet your reputable consultant to assist you with, because it's very essential, especially care is supposed to be taken at this very first period of companies and how they treat their related income and expenses. Like I mentioned before, revenue recognition is very important. IFRS 15 is very, very important. How you recognize your revenue and your expenses. And let's take note, the law recognizes the accrual system of accounting than the cash system. The law recognizes the accrual system of accounting than the cash system. This is because it helps to match your related income and your expenses, and especially when it comes to companies carrying out contracting works, project related. So much so that they will not recognize large revenue when the work has not yet started or been done. In the nutshell, corporate tax law in UAE is very simplified. Companies have to carry out continuous planning to make sure that they meet up, to make sure that they are in line with the regulations. Tax planning is very essential and it's a continuous process which companies they have to implement throughout the life cycle of their business because corporate tax is lifetime. And because corporate tax affect the company's income directly. It's not like VAT, which it doesn't affect directly. And in a nutshell, if there is any question, I will gladly entertain some questions as of now, particularly in the newly published regulations and also where doubts are since the implementation of the corporate tax. Thank you.
Okay. Okay. Sorry, am I audible?
Yes, I can get you.
Yes.
Hello? Am I audible?
Yes.
All right. Thank you, Sir Bertrand. Thank you, Sir Bertrand, for a wonderful session. So while you were speaking, some questions came in, of which I typed one.
Yeah,
Let me send it to the screen so that you can see it.
sure, please.
All right. So please, can you help answer that question?
I'm unable to see the chats. Just a moment. Yeah, can you just read it? I'm still unable to.
Okay. Sorry, another one came in. It says, what deductions are available for
See the
businesses when calculating taxable
chat.
income in the UAE? All right. Okay. Okay. Looks like our speaker is having network issues. Okay, without much ado, we've come to the end of today's session, and I say a very big thank you. Thank you for joining us. I'm Favor from Lagos, Nigeria, and it's 8:01 here. So I'll say a very good morning to you all. Thank you for joining us for this session, and we hope to see you next time. So wish you a prosperous new year and a Merry Christmas and a prosperous new year. Thank you very much. Thank you very much. All right, thank you very much. And I'm okay. Guys.
Goodbye, goodbye, goodbye.
Bye. All right. Thank you very much for a wonderful. Thank you for thank you very much, Sir Betrand, for a wonderful session. We really appreciate it, and we hope to see you on our screen next time. So thank you to everyone who followed us from the beginning down to the ending. We appreciate your time. We say a very big thank you. And January, 2025, we are going stronger. We'll bring in a lot of speakers that will enable your business grow, because the Dicalo Consulting Group, we're all about the growth of your business. Our primary assignment is to grow, is to help every small and medium businesses grow, whether you're in Africa, whether you're in the Middle East, the UAE, wherever you are. We are going to help your business grow. Thank you very much. I remain Favor Igwe. Have a wonderful day.